This is Hall Martin with Investor Connect. Today we're here with Brian Parks of Bigfoot Capital. Brian, thank you for joining us.
Yeah, thanks for having me, Hall.
Great. Can you give us a little bit about your background, Brian, and how you got into venture funding? And then let's talk more about Bigfoot Capital and what they're all about.
Sure. So quick once over on me. Basically a 50-50 split between financial services and early stage technology company operations. I spent 5 years as a M&A banker, primarily doing middle market sell side transactions. And then in 2010, moved into early stage operations. So as a employee one at an online travel distribution company, sat on the exec team of a marketplace lending company, founded and served as CEO of a digital asset management SaaS solution, and even did a stint at an accelerator here in Denver. Accelerator, incubator, co-working space, coding school, mishmash of a lot of stuff called Galvanize. And then most recently, started Bigfoot Capital in January of 2017, kind of a blending of all of that experience, having raised early stage money myself for a SaaS business, knowing a lot of founders at that stage of business, and really thinking, man, it's tough to raise money efficiently for a business at that stage. And it's obviously hypercritical to be focused on executing then, as it generally always is, but the market is just really tough to navigate for a lot of these founders. So we, as a capital provider, aim to be in a very efficient path to capital for a certain type of company at a certain stage, right? And we really only look at the SaaS business model and really only look at companies that are utilizing that model out in market with revenue.
And what's your criteria to come into your range of funding? What are you looking for? What are the minimums before you really start to engage with the startups?
Sure. So I'll just start by saying we're generally providing capital amounts of anywhere from $150,000 up to kind of 5x that in terms of our investments. So as I mentioned to you, Hall, we're not an equity fund. We're a debt fund specifically for SaaS companies. So in terms of leverage, we're looking anywhere from kind of 3 to 6x monthly recurring revenue, and which we feel is a pretty rational amount of leverage to put against these companies. And we really start to get interested as a company is, call it on a $500,000 revenue run rate up to a few $1 million in ARR.
And what verticals do you go after? What kind of deals really fit your sweet spot?
Yeah, so we're fairly vertical agnostic at this point. There's not even necessarily anything that we completely avoid as an end market. There's some that we potentially like less than others in terms of the sales cycle, kind of the seasonality of buying, such as education, for instance. Healthcare is a notoriously challenging market to sell into for various reasons. That said, vertical agnostic, we do really like verticalized niche businesses. We think they set up well for our type of financing and are oftentimes overlooked from a venture perspective and don't necessarily have the venture profile as well. So that's kind of the deal. Some of the companies that we're chatting with and ultimately investing into are on a venture path. Some are thinking they may be, but aren't quite there yet. Others are, just bootstrapped and could use some capital as well.
So as you fund these deals, you have to get in there and help them grow the business and overcome the challenges. What are the top challenges you see for companies, especially those at the earlier stage, say $500K annual revenue? What are you spending most of your time helping them with?
They're just resource constrained for the most part. These are sub 25 employee companies, so anywhere from kind of 5 to 25 heads, right? They've got customers. Now, if they're enterprise, they may have 10 customers. If they're SMB, they may have 10x that. But what they're trying to do, right, is continue building on their product, right? Continue improving it, build some sort of moat, continue getting market penetration and all of that without really blowing up their organization in terms of size, right? So there's not $5 to $10 million being dumped into these companies and saying, burn it over the next 18 months. So what we try to do is help them focus on, one, what they're really good at, whether that be product, building technology, sales and marketing. And so how we do that basically is trying to be very efficient in terms of getting them capital, for the most part, staying out of their way. But what we're good at and what we have in our DNA is making connections, right? And we're operators and finance folks kind of at our core. So we'll make connections, be that on the BD front, be that on the subsequent capital front to future round equity investors. We will make introductions to service providers that we know across functions. So whether that's agencies doing dev and design work, sales and marketing work, lead gen, hiring and recruiting, finance and accounting, part of our core thought there is it's challenging when you're at an early stage to get really good people across your company in those functions. One, because you generally can't afford them. Two, you have to run hiring processes without having a bunch of senior people, so that's always challenging. But you really need to fill in those potential holes in your business, again, to focus on what you're great at.
Well, it's true. Most of these companies are starting with that lean startup. And so the moment growth sets in, there are now gaps in the organization that you have to fill. As these companies come into your purview, what do you find the most common mistake they've made so far that you have to go and work on?
It's a good question. I'm not sure I have enough data yet, just given the size of our portfolio. Everyone makes mistakes, whether that's taking financing that wasn't that great at some point, whether it's having made bad hires. We haven't seen any catastrophic, say, product mistakes. But, one thing that does happen, and I've experienced this before as a guy that's raised money for a software business, you get money in the bank, and guess what? You start to spend it, and maybe you don't make the most prudent decisions. And that's going to happen, and you need to learn from it. It can potentially be very dangerous at the early stage when you don't have a lot of that capital to play around with, right? So the mistakes are amplified.
Well, too much money too fast can create bad outcomes. And so having a little bit of money along the way helps, but too much money is always a problem for sure.
Yeah, we're very sensitive to pre-scaling of any kind. So pre-scaling your capital base, pre-scaling your sales and marketing, or pre-scaling hiring a ton of engineers that maybe you didn't necessarily need when you could have outsourced it. So we like lean and efficient with rational burn profiles.
And of course, the other challenge I find in this space is having everybody aligned in common vision and getting along. How do you handle founder issues and employee issues around alignment, especially if you have to start tweaking the direction a little bit from where it was originally?
Yeah, our approach is we view that to be the CEO and the founding team's job, right? And so we are always here to lend an ear, to provide an opinion to some degree. But when we invest into a company, we're relying upon the CEO to be the expert of running that business, kind of managing the team, of building the organization. And so we don't tend to get too caught up in that as the type of capital we provide.
And so what are some of the key metrics you're looking at these businesses? There's quite a few around the SaaS business model, but what are the ones that you focus on in particular?
Yeah, so we very much are looking at the fundamentals of the business from a financial performance perspective. So as debt investors, what we want to see is what we like about SaaS, right, is that it's highly recurring, in a sense, annuity type revenue and cash flow at some point, and it's got great margins. So we think that all of that sets it up to be nicely leverageable while retaining long-term equity upside. And so we're really focused on the typical SaaS metrics, all of that. Some of them certainly matter more at the early stage, whereas others really just don't have enough data to be meaningful. So we're always cognizant of somewhat taking those with a grain of salt. For instance, if you've only been selling in market for 12 months, and especially if you're selling enterprise, do you really have that good of a grasp on your ultimate churn and associated LTV? You may have some thoughts around it, but it's not 10 years of history or whatever it may be. So we focus on the customer composition, the revenue composition, the underlying buildup of that revenue, bookings, expansion, contraction, all of that. And then we primarily look at how capital efficient is this business, right? Is there some way outsized burn profile that these folks are spending like drunken sailors when they shouldn't be? Certainly yet. Of course, we look at the market. We talk to customers. We don't need to see a $100 billion TAM, right, from our perspective. So slightly different lens. Customers, revenue, how they use capital.
And how much time do you spend on product market fit versus they've already figured it out, you don't have to work on it, versus they haven't quite figured it out? There's product fit, market fit, and there's also channel fit. But how much time do you spend on that aspect of the business for these companies?
Yeah, I'd say for the most part, when we come in, let's just say 50% of the companies will have like actual product market fit. Channel fit's interesting that you asked that. I think when we're coming in, folks are still figuring that out, but they have probably spent at least 2 years building the market, having it out, building the product, having it out in market, refining, learning from customers, and all of that. So we feel pretty good that they're, if not at product market fit, they're close to it, right? And it's a kind of a vague one to really know. So there's that. In terms of actually getting into market with them and them working through that. Again, our approach is generally maybe more passive than a traditional VC equity investor. Again, our kind of mantra is, hey, we're here to be helpful. Our primary value add through that lens is operationally. And that's just where we've spent our time, right? For instance, we're not enterprise sales gurus, but we know how to look at your metrics and help you think through things in a data-driven way. We can help you model out the business. We can help you understand what types of resources you may need and point you to the right types of resources without you having to go spend a lot of time seeking them out yourself. So that's kind of our general approach.
But once you have product market fit, then you really roll heavy into the sales process. And that seems to be the point where SaaS businesses either really inflect up or just grow by just a little bit, is how well they implement the sales process, getting the right salespeople, the right sales incentives, and so forth. How much work do you guys do in the sales aspect of it?
Yeah, it varies, right? I think it's fairly common for when we come in for us to see that sales is a work in process, for lack of a better term, right? There are some thoughts, there are some new things being tried. If it's, hey, we're going to move our BDR team from an outsourced thing to actually moving it in-house, and we've never done that before. So there's still a lot of risk there that's not proven out. Other businesses have a fully baked out, low to no touch, online lead gen and customer sign up, right? And maybe they got one channel that has a lot of data and they still feel there's juice to be had there. They haven't maxed out that online channel, but maybe they haven't really tried Twitter ads or haven't done retargeting yet or have some other initiatives that they haven't executed on yet. So that's a continuous test. And we just talk through those things with people primarily. And again, we rely upon folks that may be really good online lead gen folks or really know how to look at a funnel for a $150 ARPU product that should never have dedicated people selling it, right? Because the economics aren't going to work out. So those are the conversations that we have.
Well, it sounds like you focus a lot on efficiency, especially in sales and in the SaaS model. Just a few dollars every month over time can make a big difference in the bottom line and other aspects of the business. Where do you find most of the efficiency improvements come from with SaaS businesses down the way? Is it raising the price? Is it lowering the cost? Is it both? Or what do you go for first when you're trying to improve the efficiencies of these businesses?
Yeah, I mean, I guess the way I kind of think of it, I'm not sure if it's threefold, but yes, pricing, obviously important. Conversions in your funnel and sales process, obviously important. And then how quickly you can ramp people to the extent you have salespeople, right? All of that's going to drive efficiency. Maybe you make some upfront investments into your company, whether that is bringing on salespeople, and it does take some time for them to ramp, and they're learning, and you're iterating your whole sales process. So it's underperforming at first, but it's improving over time. Same thing with your, let's say, gross margin, for instance. Maybe you've invested heavily into customer success, but that's going to scale as you bring more and more customers on. So you'll have gross margin accretion there. Your funnel, you're constantly learning. So how can you get better at a certain segment within your funnel? Not the whole thing at once, but focus on top of funnel, then focus on middle of funnel, then focus on bottom of funnel, or vice versa. So all of those add margin. All of those cycle cash more quickly as you get more efficient. So we're big believers in efficiency, absolutely. Not pre-scaling. But another thing is you just got to do these things, right? And you got to recognize that they're not optimized day one. We think that much like going out and getting capital, do it as quickly as you can, right? Get skilled up on the market, utilize people that have done it before, go out and assess your options, make a decision, go heads down back on your business so we can do some of the things that I just rattled off, and then come back up and see what you need at that point.
So I guess you encourage a lot of active experimentation, a lot of A/B testing, but what do you find is most effective in trying these things out?
That's a good question. I don't know. I think you got to try them. You have to go and seek out others that have tried them, right? I don't think it's super helpful there's no shortage of content online about all of this stuff from very smart people. But at the end of the day, you got to do, not just read about it. You've got to be process driven. I think you got to measure things with data, right? Otherwise, you're not going to know. And if you don't have that, if you're paralyzed saying, oh my gosh, how do I do all that stuff? You got to find someone who just plows through things. And that could be one person, right? Who's multifaceted. And you just got to get started. Otherwise, there's just too much to do. You got to focus. You got to try to be impactful somewhere for a certain period of time. And you just got to operate.
Great. Well, you've given us a lot of good information about the operational side of it. It sounds like you've done a couple of deals so far. Can you tell us about the kind of deals you've invested in so far?
Yeah, generally speaking, so as I touched on earlier, these are companies that range at the early end from, call it, 600K ARR to really about 1.8 million across those three companies. All really what I would call SMB focused sales and marketing enhancement software. So we've got lead gen, we've got conversion rate optimization, and we've got kind of revenue generation type software. The first two of those are really primarily for online businesses. One's for, let's say, small online businesses, another one's in the e-commerce vertical, and the other one is in totally offline businesses. And so they share some commonalities. They're in different markets, but we think they're all really solid companies. One of them's on a fully bootstrapped path. One of them is maybe on a venture path, but maybe not. And the other one is definitely on a venture path, right?
Right.
So that's what we've done so far. And we've got a lot of other ones that we're evaluating and look forward to continuing to put some money into the space.
Well, that's great. Well, in the few minutes we have remaining, what did we not yet cover that you think we should have?
What have we not yet covered? Maybe one of the things we've found, what we do makes a lot of sense to us, of course, hopefully, but we're newer as well. So what's exciting about what we do to me is we get to learn along with the market and we get to evolve along with the market. So we spend a lot of our time educating founders, learning from them, but also educating them in terms of their capital options, in terms of how to go about getting capital into their business. At the end of the day, it's a tool, it's a resource for removing constraints and creating opportunity. But what we find particularly at the early stage is a lot more of the folks that we deal with and look to back ultimately are great at product, are great at engineering, are great at navigating a market, are great at online marketing, great at sales. It's rare that they're great at finance and capitalizing their business. And so we're excited to be able to play that role, help them with that, be directly helpful if we can invest into them, and always be indirectly helpful if we can just lead them to someone who may be a better fit. And then on the investor side of the house, we think we offer a pretty compelling differentiated asset class. So if you're an angel investor, for instance, and you like supporting early stage companies, you're writing $25,000 to $50,000 angel checks, or maybe you're an LP in a few venture funds, that's great. And we focus on similar type of company, early stage technology, but we've got a different asset class that's a lot more liquid, that delivers yield, that's never going to be a 10 to 100xer, but it's going to get you really nice returns.
Well, that's great. That's great. Well, it sounds like you have a great operation there and you're doing some good things with these startup companies and funding them and helping them get to the next level. Then thank you for taking time. What's the best way for people to get in touch with you?
Easiest thing to do is go to bigfootcap.com. There's a button on several pages that says let's talk or let's chat. And then just grab some time on our calendar. Pretty easy. And we're always happy to have a conversation and try to be helpful.
Well, thank you so much for taking time to talk and hope to have you back again for a future one.
Thanks all. Really enjoyed it.